right, Curtis May here from Practical Wealth Solutions, and what we're going to do in this short webinar is talk about something we call the private reserve or the private family banking system. And so the strategy is designed to help you improve, develop or improve one's financial position by avoiding or minimizing unnecessary wealth transfers. A transfer is money you're losing unknowingly or unnecessarily, and so we want to reduce those or eliminate those where possible, and at the same time we want to provide and help you develop an increasing pool of capital. What do you mean, Curtis? Money. Okay, providing accessibility, control, and most importantly, uninterrupted compounding. So the fundamental key to the private reserve account is that it must be accessible through collateralization, meaning that you can use the money as collateral and do something else with it. And I'm going to show you why that leads to uninterrupted compounding. All right. So, and here's the thing. So here's the goal of this. So ask yourself this. Because this is what this system is designed to do. So we call this the 4 pillars of a strong personal economy. So, because here's the result of what I'm about to show you. So ask yourself, would you like to be free from debt to others? Would you like to have cash, ready cash when you need it, with that you can access with a call, or a computer swipe or a fax, right? That you can access for emergencies, layoffs, car breaks down. You've got some big ticket item that would just screw up your cash flow, or more importantly, for opportunities. An unexpected vacation comes up. Somebody's got to liquidate their luxury car or their cabin, or you've got a business opportunity, or you need business equipment, something like that. You always have needs for a good real estate deal, for cash. And so you need to be able to have access to cash. Third is you want to develop passive income that you don't have to work for and that you can't outlive. See, folks, that is becoming financially independent. Is what you want, is to be able to do what you want to do and live from the income developed by your personally invested assets. Okay, that is what you're working for. That's financial independence. I don't care about the markets and markets going up or down, because that's an illusion. It's not real money until you sell your shares. Okay, and the 4th pillar is, as you learn this strategy, you got to teach it. And so we're going to show, because a fool and their money is soon parted. So you want to leave a legacy of wealth and wisdom. Okay. So you need to have instructions. What is your methodology? What is your how are you teaching people how to improve their situation, right? So what happens is some transfers are only avoidable, others you can only minimize. Here is a key point. You finance everything you buy, because you either pay interest to use somebody else's money, or you give up the ability to earn interest. And so every dollar not saved is consumed by transfers and lifestyle. All right. And so let's talk about, because here's the overriding philosophy that we teach. One is that there we go. What you got to be able to do is there's more opportunity to minimize the losses in your life than there is trying to pick winning investments. All right. So, and here's what I mean when I say that. So let's say you make 100 grand, 102,000. I'm going to give you a benefit of doubt, and you're saving just about 10% of your income, which America, as I record this, the savings rate for Americans is like 2%. All right. And so let's say you could get 5% on your savings. Now, and you say, well, 5%, you can't get 5% on savings. Yes, you can. You just don't know how. So you better stick around and listen to all of this, and I'll show you where you can get 4 to 5% on your savings. Right now, let's look at that. So now most people are focused on this. Because see, traditional advice says, look, you've got to work harder so you can save more. make more so you can save more, or you've got to get a better ROI on your savings. Well, I don't know about you. The only way to get better ROIs is to take more risk. And risk means, I hate to break it to you, probability of loss. All right. And so Warren Buffett has 2 rules. First rule of money is don't lose money. Second rule is don't forget rule number 1. So everybody talks about investment. I had somebody call me and say, well, what should I be investing in? First of all, you don't have enough savings. All right. And so let me give you a definition of investing. This is from Benjamin Graham's book, The Intelligent Investor. This is Warren Buffett's mentor. An investment operation is something that you put your money into where your principal is safe. So that $10,000 is safe, and you have a reasonable opportunity to make a profit. And if it doesn't meet that definition, it's not an investment, and you're speculating or gambling, right? And so, all right, if you want to gamble, fine, but I'm going to show you don't want to gamble with the majority of your wealth. You pick your spots, okay? And you can do a little speculation after you've done your numbers and you figure it out. So let's show you how. The first thing you want to do is folks, if you got a bucket and it's got holes in it, the first thing you have to do is plug the holes. So I would argue most people have leaks in their personal economy. So let's say we can just look at this $92,000, right? How you pay your mortgage, taxes, how you fund your retirement plans, how you pay for big ticket items, how you there's a lot of leaks, fees that you don't know that exist, that you're overpaying for stuff. So let's say in doing that, 3% of $92,000 is $2,700. And so what we ask our clients is, listen, if I find it, will you save it, right? So if we take that $2,700 that we found and we add that to the savings that you were saving, guess what? That's the equivalent of 27.6%. Why do we say that? Because 27% of 10,000 is 27% of 10,000 is $2,760. So here's the thing. How much risk did you take to do that? See, so first thing, you got to look at your personal economy and figure out, and this is what basically the strategy, and figure out. See, first you got to find it, and then this presentation is going to show you where to save it and the power of that. So you got to become efficient, stop giving your money away, and then when you get paid, it's going into somebody's bank. Why not yours? All right. So think about that for a second. All right. Now, so understand this. You finance everything you buy. Key point. So you either pay interest, use somebody else's money, or you give up the ability to earn interest when you pay cash. If you pay cash, okay, you finance it, because in order to get the cash, you had to save it first. Okay, that is financing. You finance, you self-finance it. Okay, and so every dollar that is not saved is consumed by transfers and lifestyle. Right? And so what are the transfers? So we talked about them, mortgages, taxes. So I'm going to pick an easy one. Because I know some people out here listening to this have credit cards. Okay, so the first pillar is debt elimination, right? So why is that so important? Because as we look at your personal economy, you got the debt, the interest on the debt, taxes, and opportunity costs. So here's what we mean by that. So let's say you're carrying $10,000 worth of credit card debt, and the what happens is that you're making you're being charged 18%. You're earning 5%, right? Why did I say 5%? That's where we help people get 4 or 5% on savings. All right, so if you're not doing that, you need to stay tuned for the whole presentation. Okay, so at 1 year, 18% of 10,000, you would have paid Visa, MasterCard, Amex, whatever, $1,900 for the privilege of using their money. Okay, now Now, had you been able to save that, that would have earned you, you have, so it's the first year round, but what happens to that money after time goes on? So in 3 years, as we step up, look at the power of, boom, 4 years. So you paid, if you just paid the minimums, you've transferred 70, almost $8,000. Transfer mean it's gone and it no longer makes money for you. Had you been able to keep it yourself, that money would have grown to $8,400 in your account, and this is what the lender makes off your money. So if we just look at, let's look at 10 years of doing that. You transferred away $19,000. It could have been $24,000 in your account, and the bank has made $50,000 off your money. So we're going to talk about how banks make money a little bit later, but that is critical. Okay, you got to stop giving money away. All right, and do I want to do another one? Let's do another one. Let's look at trading cars. Right, so you've got, people feel they have to have a perpetual car payment, right? So you've got the debt on the car, you got the interest, you got the opportunity cost. So whose interest? Is it yours or theirs? So let's say you got $30,000 at 6% over 60 months. Your car payment's $580. You're going to pay almost $35,000 for the car. Interest paid $4,800, just under. Right? And so here's why car makers like financing, right? The biggest part of General Motors is GMAC, is their most profitable unit. That's why the banking function, see, you're giving away the banking function. That's the most, if you're listening to this and you're in business, you need two businesses. You need the business that you use to generate money, and you need to be the bank so you can finance your stuff yourself, all right? So here's the thing. You got an investment return of 5%. You trade a car every 4 years. You've got 20 car buying years left at a 3% inflation factor. I'm going to say, we're in Pennsylvania, so I'm going to move this down to 6%. And you keep your cars, let's say, every 5 years. Car life in years between trades, right? So here's the thing. So paying for 5 cars over the next 20 years, if you had invested just the interest on those car loans at 5%, your money would have grown to $56,000, just the interest, okay? And not saying the cash of just the car, but you got to buy the car, but how you buy it is the most important thing. So this is the interest at opportunity cost of what the money would have been worth had you invested. And so you have to pay attention to opportunity cost, because it's a real cost. People say, well, I don't see it. It's like, well, it's gravity. Try jumping off a building and saying you don't believe in gravity. It just is, folks. So let's talk about this. So before you make any capital outlay, and you buy any big ticket item, you've got to consider the cost of that item, and you've also got to consider the opportunity cost. So it's just not what you pay for, it's how you pay for it. So let's say, for example, I'm going to use a car. I got somebody that's just going to try to use this to do a home improvement, and they want to cash in their account. So if you're watching this, this is for you, right? Cash in their savings and pay cash for this deal. Because what happens is, if you look at this and you've got, let's say you got $30,000 saved, and you've got in cash, right? And let's say I'm your banker. I'm saying, listen, don't cash your money in. You'd be better off financing it. And let me close it back out. This is what I do when I'm doing this live with people. I say, listen, you got $30,000. Don't, I know you want to pay cash because you don't like payments, but you might be better off leaving the money invested, and I know you got good credit, good job, I'll give you 100% financing, right? And and you'll be better off if you do that. And a question I ask people, if I'm the banker and I told you that, do you believe me? Most 90% of the people say no, right? There's a few people that get it, but here's the thing. Real estate investors get this, right? And so now, if you have $30,000 earning compound interest, see, you got to understand between compounding and amortizing. So if you've got an amortizing loan, that means every year, yes, you have an interest cost, but the principal is going down, ending at zero. So if you've got a $30,000 loan, and you know, at 5% it's costing you $566. Let's say I gotta make some money. I'm the bank on my money, so I'm gonna charge you 6%, right? And so now your payment is in interest costs, you're going to pay now $4,934 in interest. But my money earned $8,500. Think about that, right? So if you, at the end of 5 years, you could either pay cash and not have any money, right? Because if you spend this, you give up the ability for the money to make the $8,500, and even though it costs you some money, which way are you better? So this is for a car. You would still have your car that might be worth $5,000, but you would have $38,000. Okay, so you got to understand how money works. So if y'all don't understand this, call me. But that's a critical point. So you don't just want to go through your cash. You don't want to drain the tank. So I'm going to show you what that means in a second. And so what happens is, how do you pay for things? So there's there's three types of people in the world. There's the debtor, there's the saver, and there's the wealth creator. So when they pay for it, so when the debtor wants to get a big ticket item, they don't have any savings, they earn no interest, so they've got to borrow, rent a center, borrow money, get a car, and they've got to use other people's money for which they have to pay for. The saver saves money to avoid paying interest. They earn interest, pay cash. And the wealth creator, notice how the saver and wealth creator are two different people, saves money, uses OPM, other people's money, for maximum efficiency. Oops. Right, there we go. So the wealth creator saves money, earns compound interest, and collateralizes their purchase. What does that mean? Come back to that, right? So when they borrow money, so the debtor, see, if you don't have any money, what you're doing is you're using future earnings as collateral. Understand that, okay? So if you don't have any savings, somebody loans you money, they're looking at your job, looking at your credit report, you're obligating future earnings. That means you're making payments against, you've spent money you don't have yet, okay? And you're collateralizing your future earnings. Let that sink in for a second. Savers to avoid paying interest, they borrow from themselves. So you finance everything you buy. So when you pay cash, you financed it, and you reduced your cash, your collateral position, and it resets compounding, because compound interest only works if you have money in the account, all right? And the wealth creator saves money, uses OPM to maximize efficiency. So they borrow from a lender at negotiated rates using their own money as collateral while they continue to earn uninterrupted compounding. Well, how do they pay for things? So the debtor makes payments to a lender and generally pays the highest rates. The saver redeposits the money back into their account to get at the level they want to keep their savings at. So they make payments. So deposits, payments, same thing, okay, to get back to where they were before the purchase, but they gave up the interest they could be earning. And the wealth creator saves and uses OPM to maximize efficiency. So they make payments to a chosen lender, because see, if you've got money banks will follow you, and you get to buy interest. And so what they do is they maximize the benefits of their compound interest account. All right, so, uh-oh, why is my recording freezing? So this is what we call the zero line. So there's three types of people in the world. So there's the saver, the debtor, and the wealth creator. So the saver saves money. They pay cash. They pull the money out, and they save cash and they pull the money out. Wait, there we go. That's what I want to start with. All right, so let's go back this way. So here's your debtor. Debtor, you don't have any money. You got to borrow money, you pay it back. You got to borrow more money, you pay it back, and you end up working your way in your life back to zero. So here's the saver. Saver saves, pulls money out, puts it back, pulls it back. So how do you feel if your savings were up here at 30,000 and you had to pull them out to make a purchase? Yes, you don't have any payments, but you don't feel good because your cash is messed up, right? And so now you've got to build that money back up again, right? And so see, which one are you? Are you the debtor or the saver? So there's a third type of person. There's the wealth creator. All right. And so think about this. So now you've got money, but you don't want to use your money. So you collateralize your money, and you get utilization, right? But you still get growth. So you live your life, your wealth gets better every year, all right? And you still get to enjoy the fruits of your labor. See, which one would you all rather do? All right? And so here's the thing. Which one would you rather be? The debtor, the saver, or the wealth creator? So you better say wealth creator or cut the tape off. Right? And so so here's the thing. So what is the problem with consumer debt? Now I'm not going to spend a lot of time on this. Y'all know this already. So consumer debt is the obligation on future earnings, right? You lose the capital. Once you spend it, it's gone forever. You're a debtor to the creditor, and you lose control, and it's a very inefficient consumer strategy. So what's the alternative? Pay cash. Well, okay. Do you know there's a problem with paying cash? And what's that, you say, Curtis? All right. So first, in order to pay cash, what do you got to do? You've got to save cash. So you've got to fill the tank, right? See, the first problem is you've got to fill the tank, right? So you've got to save up some money, right? And so the first thing you got to do is you got to save, right? And so now when you right, so you got to fill the tank. Oh, got that worked. All right. And so now what happens is you got where most people store their cash, you got to pay tax on that money. So you have leakage. Let's not even talk about inflation. And what happens is you have to do what? When you use your cash, when you make that big ticket item, you have to drain the tank. So you start back over again. You spend your whole life starting back over, right? And so what happens is, let's look at the true cost of paying cash. So this is powerful. So let's say you have this brother or sister, you pay $5,000 a year, and you save $5,000 a year, and at 5% over 30 years, that money would grow if you just could leave it sit to $353,000, right? But you had a brother. So your brother saved up the same $5,000 a year, but every 5 years they took the money out. They did pay it back, which is what most people don't even do. So they pay it back, but look at the difference. You never catch up. So he or she, they only have, you have 353, they've got 71, and the difference is a big one. That's $282,000. That is the opportunity cost for paying cash. So I told you that was a real cost. And so here's the thing. So if you look at the difference here, let's see if I can move this over. That money would grow, so it's 5, 10, 15, 21, uninterrupted compounding, right? But look at this account over here on the right, 5, 10, 15, 21, drain the tank, right? That's the saver, right? Drain the tank, 15, 21, drain the tank, and you end up, you never catch up. So if you keep draining the tank, you never catch up, okay? Now, let's keep going, right? So, think about this. What if you could make a purchase without emptying the tank? You say, right? And, oops, that's not where I want to go yet. Seriously? So this will allow your private reserve to continue to employ the benefits of your banking system to employ the benefits of compounding. And if I don't use my money, whose money do I use? You collateralize a loan from your friendly neighborhood financial institution by pledging a portion of that reserve. So what does that mean? So you want to pay yourself first, right? So you want to fill your green tank. You want to fill your savings bucket, right? And so now you've got money. You know the power of leaving that money alone, but you still got things you need to do. You got weddings, you got school, you got cars, you've got business equipment, you've got real estate deals, we use ours to pay for kids' summer camps. I mean, life, $1,300 summer camps that they pick off of Lake Michigan, to be specific. It was great though, but it wasn't free, right? And so I'm going to say, well, hey, I've got this thing, Mr. Financial Institution. Can I use your money? I'm going to use my money as collateral. And so what happens is the power of that is I'm going to pay it down, my collateral, and the power of this strategy is that you get to continue to earn money on your collateralized funds. Okay, so you get uninterrupted compounding, so you get utilization and growth. So that puts you in the wealth creator camp. Okay, and so when we talk about savings, what I want you to do is focus on how can I build that collateral capacity. Well, 3 things do that. Contributions. So you've got to capitalize your system, folks. You got to put some money in. Internal growth of the account. And lien reduction. We call that being an honest banker. And then as you pay it back, as you make more money, as your personal economy grows, as your business grows, you keep saving. Can't save too much money. So let's look at, so now you like the idea of the private reserve. So now let's create the ideal place to store your cash. See, wealth has to be warehoused somewhere. So where would you like to have it? So think about this, and we're going to compare this to what you like to have compared to what you do right now. And so would you like to have tax-deferred growth, tax-free distribution, be able to get a decent rate of return, put in as much as you want? It would be great if the contributions could be deductible. Use the money for collateral. It's safe. You can't. Safe harbor means creditor protected from lawsuits. No loss prevention provisions. Guaranteed loan options. So if you needed it, you could get a loan against it. Use and collateral. And you can create your own payment plan. You can create your own terms for how you pay it back. Stop it, start it, pay it back fast, pay it back slow. It's not going to affect your credit report. The magical money bucket, right? And so you got liquidity, use, and control, which is key. So now many accounts work as a private reserve. Some work better than others. So I want you to think about, there's not many places you can store cash or money, right? And so let's remember our benefits that we want. Right, which are here. And how many of these benefits do the things that you keep your money into have? So now that we know that this is the account we want, what gives us that? So where can you put money? Where do people store money? So you've got 401ks, you've got CDs, you've got margin accounts, you've got, so this is where you store like liquid money. This is what I call your this, you know, we teach people that's 4 asset classes. Business, in terms of investing, there's 4 asset classes: business, real estate, paper, and commodities. Commodities, gold, silver, oil and gas, that type of thing. And so farmland, you know, I know people that invest in coffee farms in Panama that do very well. All right. And so you've got CDs. So I'm going to go through all these right now, but most people pick, let's pick the 401k. So 401k has some benefits. It doesn't have all the benefits, right? Tax deferred, competitive rate of return, that's debatable, depends. Collateral opportunities, you can put the money as deductible. But let's look at this. People say, well, I can borrow against my 401k. Well, let's break that down a bit. So 401ks are limited to a maximum of $50,000 or 1/2 the account balance, whichever is less. So you've got $100,000, you can borrow maximum of 50. If you've got 50, you can borrow a maximum of 25. All right. Loans must be repaid in less than 5 years, so you don't really get to control the cash flow. So if you take a lot of money, that's a nice payment, and so it might not, if you want to use it for. Remember, even though you're paying it back, you're still you're still cutting down your current lifestyle because you have this payment. So it's not the best thing, but it is good in a pinch. And so if this occurs, the account holder is less than 59. So if you don't pay the loan back, it's considered as a distribution, and you get a penalty on top of your ordinary tax rate, right? Because the money is treated as a distribution. Interest is paid out on a later, if like basically you get double taxed, and if you got money outstanding, a job change is a considered distribution. All right, if you got money outstanding. So let's pick another one real quick. Savings, right? Well, savings, money markets, interests are low, money's taxed. Call provisions is not necessarily that you can use as collateral. You pretty much have to withdraw it. So you can put in high. So what are the benefits? High contributions, collateral opportunities, safe harbor, liquidity, use of control, but doesn't have all the stuff. So what does, you ask? Nobody ever picks this one, but we're going to talk about permanent life insurance. Yes, I sell life insurance, right? But it's not your grandfather's life insurance. Most plans aren't. You've got the structure. So specifically, we're talking about dividend paying whole life insurance from a mutual company. So that's probably around 15 companies. So you're watching and saying, oh, hey, your cousin works at, well, I'm not going to say, your uncle sells insurance for so-and-so. If you haven't heard this, they don't do this. Right, and because they don't train on it. I had to learn this stuff. I had to deprogram myself from the company I used to work for, and it took me a few years to figure this stuff out, and money, figuring out how to do this stuff. But so let's look at permanent insurance. So as a place, it is the perfect place for stored cash. All right, so look at your benefits over here. You have all the benefits. So here's the funny thing. Let's look at where people save money, right? And this is where you save money, and look at the red, folks, and this is all of the stuff that you said you wanted, there's only, except for, and you don't really want deductible contribution, because if it goes in pre-tax, that means it's taxable coming back out, and it's taxed at a bigger amount. So why would you not do this, right? And so let's look at the insurance. So what happens is there are riders that may be available at additional cost: critical illness, chronic illness, long-term care. Once dividends are paid, dividends and insurance are companies that we use haven't missed a dividend in 100 years. It's not like a stock. They're not taxed, but once they're paid, that's your money, and it never goes down. Cash value grows. In insurance, they call the savings portion cash value tax deferred. Loans are built in. It's a contract feature. The death benefit is paid. There's a death benefit, so that the money is income tax free. There's a deficit. It doesn't go in dollar for dollar. Usually we can get it in there at 55-60 cents of every dollar the first year, and then by year 3 or 4, on another video I'll show you example of that, of how it's a very efficient cash accumulation tool. So let me give you in 5 minutes a 10-minute lesson on life insurance, all right, and why it's a good place to store cash. So what happens is, let's break it down. So what happens is, you've got a minimum you can pay for insurance, you got a maximum. The minimum is set by the insurance company, and so it's infinite ways to design a product, and it's designed by the actuary. So basically on the lower end, that's term insurance. You want to get and there's no right or wrong here, right? So it's not term or this, you need both, all right, because most people are underinsured, and you can't even afford you want to solve for human life value. And so if you're 35, 40, you've got young kids, and you make 50 grand a year, you need to just multiply your income by 15 to 20, and that'll tell you how much life insurance you need. So you're like, oh, I got 250,000. You don't have no coverage. You're not covered. You're underinsured. Okay, let me be clear. And so if you were in 9/11 and God forbid you've gotten killed, that's how they calculated how much to pay the families. Okay, human life value. So most people are playing themselves cheap. So what happens is, there's a maximum you can pay for it that is set by, guess who? The government. So now if they want to minimize what you pay for insurance, or they remotely care what you pay for insurance, I don't know, that tells me, I don't know about you, that it must be pretty good for me from a tax standpoint, right? And so what the government did when 1987 was, because they want to engineer stuff, they want you to do what they want you to do, which is put money in retirement plans, qualified plans. Qualified by who? The government, right? And so you're deferring plans, you're deferring your money. So what happens is, if you try to do it with insurance, you put in too much money, then they treat the money tax wise like one of these, right? And that's not what you want to do, all right? And so let's talk about qualified plans for 2 seconds, right? So what do? Here's what they do. They defer taxes, and they defer the tax calculation, right? And so here's a better word: postpone. And you got to ask yourself, what tax bracket will you be in when you retire, and what deductions will you have when you take the money, right? And so here is the history of taxation in a country. So we're in a historically low tax period, right? And so they have been as high as 94%. Okay, and so these are, a lot of them are associated with wars, but here, so that we're in historically a low tax period. So if and let's say when you look at your qualified plan, you say, well, okay, I got $500,000 in there. Yes, in theory, but if your house is paid off and that money comes back out as ordinary income, right, which is the highest tax. So if you've got $30,000, government has issues, they need money, and unfunded liabilities, where's that money going to come from? Okay, So they're going to let you know how much they need of that money because they control it, so they can control the rules. So let's say you're in a 29% tax bracket. Your share, the IRS's share, sorry, of that $500,000 you think you have, no, you don't, because don't forget your partner. So you really have 135,000. Okay, and that's a whole other talk, but I just want you to to chew on that for a second, right? So let's go back to the private reserve. So we want to not do this, okay? We don't want the money to work like a retirement plan. So here's what we do. We structure them so you can pay $1,000 for a $500,000 term insurance, or you could pay $10,000. Well, why in the world would you pay $10,000 for something you could get for $1,000? Because what happens is when you structure it as a cash accumulation tool, here's what happens to that extra money. All those good things that you like, you get. And so what we do is we minimize the death benefits. So when we create maximum efficient contracts for the banking strategy, you are lowering your you have to lower the death benefit. You minimize the death benefits, that you emphasize the living benefits, the money, and so with the money you have access to all of these benefits with your cash. Okay, and that's what we call building a maximum efficient contract. So now what happens is, let's look at using permanent life insurance as a private reserve. Well, so now you know that your green tank is the cash values of the insurance, right? And so now we know the financial institution is the life insurance company. So now you've got the thing over here you want to do, and you're going to say, well, all right, I've got this thing. I'm going to call my insurance company and say, listen, I need $5 grand, I need 10 grand, I need 50 grand. How do you get that? You got to put it in there first, folks. Okay, it's not magic. And so you got to save money. So you got to build your collateral capacity. You've got to save money. So you can't do, you can start wherever, but if you're putting $100 away, you know what I mean. It's just it's not, you're not going to be able to buy a car with it. All right, you got to put some money away. So now what happens is, but once you do that, you have to once you do that, what happens is they loan you the money, you get the thing you want to do, you've got a non-structured payment, and you just pay it back, right? It releases the lien against your money. So now what's the power of that? See, permanent life insurance, when designed and utilized properly, can provide stable growth, cash value collateralization, a guaranteed loan access, no annual tax on the growth, a death benefit, and additional benefits, that are available, with various riders, right? So what happens is the opportunity, let's look at, so that's the private reserve strategy, okay, in a nutshell. So you want to save money, and so now once you make that the center of your financial world, everything you do gets more efficient, right? And so with the efficiency enhancer, we say, look, what you want to be able to do, so if you borrow $5,000, right? So the insurance company is going to charge you, let's say 5%. So what we teach people is to pay themselves back, or pay the insurance company back, or at 8 or 10, right? So if you pay that back, where does that extra money go? That extra money goes into your green tank. So now on financing, what you've done is you accelerate the payment, you lower your interest costs, and then you force more money into your banking system, right? And so you fill that extra cash flow, and then once you fill it up, you can buy more tanks, right? And so we have clients with 8 or 10 policies, accounts, that they use for vacations, for equipment financing. This one's for this, that one's for that, and that's what you want to be able to do. All right, and so let's talk about one more example. Let's go back. I messed it up. Okay, and so what happens is, all right, so let me give you 0.76. Okay, and now, so he's got a financial opportunity that he's loaning somebody wants to get a franchise, so he's charging them 8%, right? So now here's what happens. He's got to pay back, he's got a cost of funds. That's why I say when you're looking at investments, you got to, this kind of forces you to make sure that you've got a good deal, because if you can earn 4% tax-free, which is like 5.5 or so, with no risk, why would you put money at risk for low rates of return? Okay, and so you've got to give yourself a hurdle rate. That's EVA. I want to do another talk on that later. And so what happens is you've got what looks like, all right, so you've got 3.24% or $1,600 growth on top of the cost of the money. It's actually a little bit more than that. And so you got three options. So you borrowed against the policy, you've got $50,000. You had an opportunity outside of the policy. So first of all, think of what's happening now. You've got a death benefit, you've got your cash, you've got access to cash, you can collateralize your cash, and you can take advantage of another opportunity and still have all of the other things going on, okay? With all of these benefits are still happening with that money, okay? Tell me how your current place you store cash stacks up against this. Now, here's the power. So now you have three opportunities. You can add more. You can go back and double down and go get more of the opportunity. You know what you can happen with your, when you have excess cash flow, you can now repay your policy loan, and if you still have excess cash flow, well, that money is going into somebody's bank. Why don't you create another bank, i.e. policy, to store the rest of that excess cash flow, right? So that, you know, that's pretty good. You've got multiple dollars doing multiple things, but it's even better than that. And so let me show you how, let me attempt to show you, if I can do this right, how banks make money. If I can make this thing work right, right? Here we go. All right. So here's the guts of that transaction. So he loaned $50,000. Now he knew he could get $50,000 from his policy. So the gentleman wanted to get a franchise and needed a 1-year loan for $50,000. So this is all right. And this is actually, because I'd have probably charged him more than this, but he charged him over a 1-year period. He charged him 8%. So that means he made $4,000 on his money, you know, because the guy paid him back 54 and he loaned him on the 50. So you got to look at that, right? Now, let's look at what he did though. So he knew he could go, so remember that $54,000 number. So he knew he could go to the bank, the insurance company, and he could get the funds for 4.76. So he had to pay back $52,380. So the money cost him $23.80. So think about how banks work. You put money in the bank, they pay you 1%, and they might loan it back to you or loan it to somebody else at 4 or 5. Okay, and you're like, oh, you know, big deal, 3 points. Okay, so that's $2,300. Now let's look at what really happened. So now that let's look at, so his cost of money was $2,300. So now let's take the 2,380 and in 12 months, so we're going to figure out rates. In 12 months, he made $4,000, right? And so what is that? That is a 68% return on investment. Because and because it's leverage. It's not even his money. It's using the insurance company's money. So could you buy a new kitchen with this strategy? Could you, and make, kind of retain your profits? So you've got to see this whole process. You got to change your methodology about how you view money. All right. And so that's the power of, and that's a quick example, but guys, that is the private reserves. There's so many things. So this is an introductory, because this is like a 10-hour process. But if this intrigues you at all, you say, well, all right, I've never seen this before. I like no risk. I like the 4 pillars of a strong personal economy: freedom from debt to others, ready cash when I need it, passive income I don't have to work for, and I can't outlive, and I want to build a legacy of wealth and wisdom for my family. So if that's you, and so it's two types of people. It's like, wow, I'm in, Curtis. What I'd like to do is after this, you'll see where you can apply to work with us, and we can see if if working with us is a good fit. And you say, well, Curtis, I have more questions. On our website, you can use the 15-minute appointment to schedule a 15-20-minute brief strategy session. But also, we're going to give you the ability to go through Practical Wealth Academy and learn more basics on your own pace. And when you're ready and when it makes sense to you, call us. Of course, if you have questions, but check it out. There's tons of collateral material. I'm going to put in the notes, Become Your Own Banker by R. Nelson Nash. If you will email me, I will send you to give you a good head start before our conversation, Live Your Life Insurance. And then my favorite book on the subject is a book by Jeffrey Reeves called Money for Life. And so there's a lot of homework, because you have to get knowledgeable, and you have to be able to keep your own counsel. And if you're unwilling to do some homework and figure this out, or be willing to change be coachable basically, and to figure this out yourself, then we're probably not a good fit, because that's too hard to work. But if you're willing to do the homework, too hard to work for me. And so if you're willing to do your homework, let's talk, and we'll show you how this, because see, this strategy will help you be more efficient. It boost your real estate gains. It will enhance your whatever you do in business, folks. If you can be the bank, everything you do becomes more efficient, and it's like flying a plane where you always have a perpetual tailwind. So everything you do will get better. So anyway, that's my short, long introductory presentation to the Family Banking Private Reserve System. Reach out if you have any questions. If you like this idea, then let's talk.